Now, looking at the inflation picture, we saw inflation falling back for the third straight month to 16.69% in February. How has the inflation scenario changed interest rate expectations?
Of course, what we were all waiting for, I think, and most investors actually in the market were waiting for a bit of consistency. And inflation coming down over the last 3 months, and the last drop we saw was quite significant. This has given the market quite a lot of confidence, and this week has seen a lot of activity on the secondary market. And as you know, of course, the first effects are usually felt on the secondary market before they begin flowing through to probably commercial lending and also the the central bank rates.
Now, looking at the local debt market, what type of yields are we seeing coming through after that decline in interest in the inflation environment?
This week has been exciting on the secondary market, the fixed income market, that is. I think, no, actually on both markets. The fixed income market has seen immense demand, and we've seen the new papers which just have been issued. That's the one-year paper, the 411-2, which is a 2-year paper, and also the infrastructure bond, where they did a tap sale also in this month. We've seen a lot of activity on those papers. We've seen the one-year paper come down by about 150 basis points. This is within a space of about 4 days. The infrastructure bond has been the most impressive. We've seen it come down by about 250 basis points. I think it traded at a low of about 14% today. Which is quite impressive, coming down from about 16.6%. And okay, of course, maybe there is a bit of exuberance in the market after we saw inflation come off by such a big gap. But we may see this decline continues to slow down. But also on the prime rates, we're seeing all the prime rates are now at below levels of 19%. We have the one-year T-bill next week, which we also expect to come down below 19%. This is all very positive news coming through to the market, and we should see this filter through lower now to commercial lending rates, interbank rates, and probably next week is the MPC meeting. Okay, we expect they may hold the rate where it is, or if they do reduce it, may come down probably by a very slight margin, probably maybe something like 50 beeps.
Talking about the MPC, which is due to hold a rate next week, what will this do to commercial lending rates? You are seeing them dropping rates in next week's session. Would this then lead to a decline in commercial lending rates?
Sadly, the reaction is not quite the same when the CBR is reduced and when the central bank increases the central bank the rate. Of course, the decline of about 50 beeps, I do not think will have much of an effect on commercial lending rates. Banks are still cautious on going forward, actually, for this year. And I think they may hold off and wait till the end of, probably somewhere through mid of second quarter or the end of the financial year before they can look at reviewing their rates.
Now,
although there is a lot of pressure coming through from the government.
Looking at the shilling at this stage, it did lose some ground towards the end of the week on the back of the finance minister's comments. Can we expect this kind of fall to continue for the shilling going forward?
The shilling has actually, you can't say really fallen, okay, probably by a few points, but it's been trading range bound for quite a bit, between 83 and 82. We expect it to hold these levels going forward, probably for the next month or so. And yes, we actually did see the shilling strengthen. That is at the beginning of, late last week, at the beginning of the week, although by very slight margins. There was quite a bit of foreign currency inflows we saw coming to the debt market and also into the equity market. I think it's with all the excitement of the inflation numbers, the earnings season, we've seen the equity market have what we can call a mini rally. So there's been a bit of FCY coming into our market. But going forward, I think we should see quite a bit more FCY coming in, especially into our domestic debt market, as we see people trying to capture these the local debt yields.
Looking at the Treasury, it has raised about 83% of the borrowing budget for the year. how is this going to affect the Treasury's cost of funding going forward?
This is actually positive news for the market because that 83%, they've actually borrowed about 99.2 billion so far out of the 119 billion they were looking to borrow for the full financial year. This is also including the loan of about $600 million they've picked up. So that leaves them with, I mean, they have about 20 billion left to go with 3 months, actually 4 months if you consider March. So, I mean, they have the pick of, I mean, what they can take. CBK will have the upper hand, actually, I think, for the remaining part of the financial year, where they can decide on, I mean, the rates, because there's quite a bit of liquidity. We're seeing investors falling over themselves trying to lock in these yields. So we should, this is actually positive news for rates, and this CBK almost being at the point they're looking to get at, almost having borrowed the full 119 billion. This will also put downward pressure on the rates going forward.